Greetings from 3Edge Asset Management, and welcome to our monthly View from the Edge podcast for June 2020. My name is Fritz Folts. I'm the Chief Investment Strategist here at 3Edge.
And I'm Eric Biegeleisen, Director of Investment Research at 3Edge.
As we do each month, Eric and I are going to discuss our firm's most recent outlook for the global capital markets, which is based upon our proprietary research model. And we'll point out any significant changes to our outlook which may have occurred over the course of the past month. So let's get started and let's talk about the markets. Last Friday marked the end of May for the markets, and U.S. equities continued to advance, the S&P recording its second consecutive positive month. In fact, the past 2 months were the strongest consecutive months of investment performance for the S&P 500 since April of 2009. Equity investors seem to remain convinced that reopening of the economy will lead to a somewhat of a V-shaped recovery, or perhaps that even if the economic rebound disappoints, there's still a belief that the Fed has the markets back, at least for the time being. Meanwhile, on the economic front last week, the Labor Department actually reported some good economic news. The number of jobless individuals declined by approximately 4 million. For the first time during the coronavirus pandemic, in a sign that people are actually starting to go back to work. However, economic damage from the COVID-19 crisis is still profound. The U.S. reaching the tragic mark of over 100,000 deaths from the virus last week, and with over 40 million Americans having now filed for unemployment benefits over just the past 10 weeks. Also, for the time being anyway, investors seem to be looking past the nationwide social unrest and focusing instead on the positive signs of businesses reopening following the COVID-19 crisis lockdown. So with all this going on, glad to have Eric Biegeleisen here with me today to sort it out. So Eric, let's discuss the 8 major asset classes that represent at least the high-level view of our investment universe. And in particular, let's see what may have changed since early May. And maybe we could start with the equity markets, which certainly enjoyed another strong month of performance in May.
Yeah, absolutely right, Fritz. As you noted, we've seen a rather dramatic rise in equity markets over the last 2 months. From the bottom of March 23rd through the end of May, U.S. and German equities are both up over 35%. It's not accounting anything happening now in June, while Japanese and emerging market equities are both up over 24%. It's just remarkable performance, especially given that backdrop that you laid out.
Right, it does seem crazy. So let's maybe we could just take a look at each individual asset class, equity asset class, one by one. Start with the U.S., which is now, as I said earlier, racked up 2 consecutive months of pretty strong performance. What's the model saying about the U.S. market right now?
Yeah, I think this is another case of don't fight the Fed. The aggressive actions and the so-called jawboning by Jay Powell at the Federal Reserve Bank have given investors comfort that he will be there with more stimulus if it's needed, more printing of money, more monetization of debt, more purchase of corporate credit. This really seems to be buoying the markets in what seemingly should otherwise be a market closer to the March 23rd lows or even lower. We've also seen the dominance in the market's upward move come from a handful of familiar large cap technology stocks. That is to say that there's not much in the way of market breadth for this current rally. With that said, though, despite our model research suggesting U.S. equities remain highly overvalued, they may now continue to get even more overvalued as equities continue to climb. But it isn't without risk. Right. So while we have a more positive outlook on U.S. equities than we did just a month ago, it may prove to be short-lived.
Very good. So maybe now let's take a look at Japan. An equity asset class that we regarded as significantly undervalued for a long time. And it now looks like it's more favorably valued, or not favorably valued, but has a more favorable outlook in terms of the model research.
Yeah, that's right. Yeah, I mean, we it seems like we do this each month, and each month you say, tell me about Japanese equities. And each time I say, Japanese equities generally give the same answer, highly undervalued by our measures, but just no signs of a catalyst being present. Perhaps now, though, that we might be seeing that change and that catalyst, long awaited, may be here. Most notably, we're seeing a steepening of the yield curve, which points to improved growth prospects in Japan. In addition, Japan has weathered the COVID-19 pandemic better than countries and lifted its state of emergency in stages last month. Finally, Japanese companies are also experienced in operating in a low growth environment with more resilient balance sheets and more stable dividends. So this could be the opportune time.
Time will tell. Last month, emerging market equities had a strong investment performance. What's our research showing us in EM equities currently?
Yeah, our outlook for EM equities is mixed to positive based upon the model's yield curve measures for both emerging markets and the US, which are steepening, suggesting, as in the case of Japan as well, the prospect for future growth ahead. So optimistic.
Okay, all right, good. And then let's take a look at Europe, European equities, German equities. Europe may benefit from this recent announcement regarding potential for fiscal stimulus across the EU, which would be really something new there. What's our research telling us about Europe and Germany?
Yeah, that's right. German equities have had quite a run, as we discussed. And our research is showing a mixed to positive outlook like EM on the basis of this renewed investor enthusiasm, likely as a result of this proposed coordinated fiscal and monetary stimulus by the European Union. In addition, we've seen a tightening in corporate credit spreads. So should these trends persist, we would have a decidedly more positive outlook looking forward.
Great. All right. Now let's switch from stocks to bonds. And what are we seeing in terms of our model research in terms of fixed income in both rates and credit?
Yeah. Like last month, the model's preference in fixed income is in favor of a blend of shorter term and intermediate term US Treasuries. With regard to credit, the outlook has improved, but uncertainty remains regarding the shape of this recovery, as does the degree to which the Fed intervenes in the credit markets. So until there's more certainty, we'll want to avoid that space for a bit.
Very good. Real assets will shift to that. That would include gold and commodities. And why don't we start with gold, which has been, attractive in terms of our modeling for a good period of time now.
That's right. Yeah, gold continues to be supported by these Fed interventions, money printing, along with the enormous fiscal stimulus CARES Act. In addition, gold continues to be buoyed by positive investor psychology. So very much in the same wheelhouse that we've seen gold for quite some time.
And commodities, that's been an interesting asset class where it's sort of been almost at the zero bound of not attractive, not negative. Any change there at all?
The outlook for commodities remains mixed in the short term as forecasts for global growth remain just highly uncertain. That being said, though, and we've mentioned this before, from a longer term perspective, commodities are significantly undervalued and have great room for upside once and if global growth does stabilize and or supply is reduced relative to demand. So again, something we're keenly watching because I think we're eager from a valuation standpoint to get invested, much like Japan was the case for many months now. So we're just looking for that catalyst to get in.
Very good. And then lastly, short-term fixed income, cash equivalents, dry powder is still dry powder. And what are we seeing there?
Yeah, well, while we've invested client accounts to some degree in some of these other assets that we've mentioned, short-term fixed income and cash continue to serve as dry powder in client accounts to reinvest in assets at hopefully lower prices in the future.
Excellent. Well, thanks, Eric, for getting us caught up in terms of our market outlook for the global capital markets. And now, as we do each month, I'll ask Eric for 3 most important takeaways from today's video podcast. So, Eric, what do you have for us this month?
All right. Number 1, the sharp rise in global equities may have more room to run as yield curves globally steepen, while central banks around the globe continue to prop up markets with additional stimulus. 2, more specifically, our research now places a positive outlook on both US and Japanese equities, while European and emerging market equities have a mixed to positive outlook. 3, gold maintains a positive outlook as central banks around the globe continue to print money and governments around the world provide fiscal stimulus programs. Altogether, longer term may have the impact of debasing the world's major currencies, which would be a positive for gold, which is priced in dollars. Additionally, this too may be a longer term positive for commodities, which is also priced in dollars.
Right. Great. So we could say that we're marginally more positive towards the equity markets in general this month than we were last.
Yeah.
But still concerned about the valuations in the U.S.
But still concerned and watching all the signals that we do for any turning points. Yep.
Great. Excellent. Great. So that will do it for Eric and me here at 3 Edge Asset Management. We will be back once again in early July with another View from the Edge video podcast. As a reminder, our podcasts are always available on iTunes and our website, 3edgeam.com. In addition, all of our videos are available on our YouTube channel. Please feel free to share any of the videos you think that someone you know may be interested in listening to them. And so that's a wrap. And from everyone here at 3 Edge, stay safe, stay strong, and keep the faith. And thanks for listening.